right. Well, just wanted to go over some basics, just some mortgage 101 with everybody. And Phil, how do you want to handle this? Do we want to hold questions to the end? Do you want them to just, kind of speak up as we go, or what would you prefer?
Why don't we, just to make sure you get through everything, why don't we just have you run through and then we'll open it up for Q&A at the end.
Cool. All right. Sounds great to me. So
write down
again,
your questions as they come, okay?
okay. All right, guys. So it looks like there's a chat going too. So if we've got questions on chat.
Yep.
So Renee just asked me before I dive in, I saw Matt's office or offers the 1% down payment program. Yes, we do. That's something we can do a separate training on, but it's a conventional loan with a 2% grant. Requires 3% down, 2% of it is covered with the grant, so you only got to come in with 1%. So it's kind of something we can touch base on as I move along here in the presentation, because really I just wanted to first talk about just traditional loan programs. So I'm kind of, and I apologize if some of you could teach the class yourselves, but some of this you might already know, but I don't know who's in the room. And so kind of want to go real basic with things, kind of back to, elementary school, if we will, just the basic loan programs that are available out there. And really to start here, just kind of the minimum down payments for each one. But, the first one that comes to mind for a lot of folks, I think is an FHA loan. Now the loan limits can vary by county. So depending on the county that your client is in, they may or may not qualify for it. Salt Lake kind of county areas, this northern Utah area is going to be just over 600,000 as a loan limit. But once you get out of this kind of Salt Lake, Tooele, Davis, Utah County area, county loan limits can drop to 498. But if you get up to Summit County, you're at 1.149 million, which is pretty crazy to think you could put 3.5% down on a 1.1, almost essentially $1.2 million property. But 3.5% down is going to be the minimum down payment requirement. You could buy a 1 to 4 unit property with that. Now, there's going to be some challenges if you're going to buy a 3 to 4 unit property, because in that scenario of a 3 to 4 unit property, obviously you got to live in it. But the rents from the other units are going to, the rents for, I should say, all 3 or 4 properties are going to have to at least cover the mortgage payment. The only way FHA will approve it, right? So, it's really challenging in this day and age with where interest rates are at to get a 3 to 4 unit property go through, but a single or a duplex like that, is not the case, right? We don't need to do that self-sustainability test. So, 1 to 2 units is going to be no problem there with FHA. Now, FHA is a little bit more strict on appraisals. They're going to be a little bit pickier about the condition of the property. So if we've got, flaking or chipping paint, if we've got any roof issues, we've got any cracked windows, your smoke alarms, CO2 detectors, strapping down the water heater, things like that, right? Missing handrails. It's really just kind of safety issues too. So if there's any of that, you've either got to know that the seller's got to help cover that, or if you're working with a buyer, right, you got to know you're going in, and we've got to address these during the inspection phase, I guess is what I'm trying to say. So appraiser will call out what's going to be required in order for FHA to sign off on the loan. But, so FHA appraisals are a little bit more strict than, say, a conventional appraisal. I would say FHA is probably the most flexible with debt to income ratio. You can go a little bit up over 50%. When you get above 50%, it's kind of a, case by case scenario. And if what's called automated underwriting actually will approve it, right? So like, for example, today I got a client with a 630 credit score approved at a 53% debt to income ratio on FHA. So even though they've got a lower credit score, we were still able to get them approved FHA at, 53% debt to income ratio. Now, conventional is probably more commonly used, I would say. Loan limits are going to be significantly higher. Kind of the baseline for loan limits this year is going to be 766,000. So a lot more homes can fall into this, category here. And, if you're in some of the higher cost areas, like Summit County, you're up at that 1.149 million. But, minimal down here, first time home buyers is the 3%. As Renee requested, or made note, the 1% down option we've got is essentially this loan product, 3% down with a 2% grant. Now, the challenge with that, 1% down program that we're going to see kind of in the Salt Lake County areas and surrounding is going to be the loan limit. Max on that's only going to be 350. But on a traditional conventional loan here with 3% down, you can go up to that 766 loan amount for first-time home buyers. Now, 5% down if you're a non-first-time home buyer, as long as it's a primary residence, you can go 1 to 4 units. You do not need the self-sustainability test like you do on FHA. So, we've had clients that have tried to go down the path of 3 to 4 units on an FHA loan. That self-sufficiency test, I guess is what it's called, didn't work out. So we had to switch them over to conventional, had to put 5% down instead of 3.5% down. But that's a new program. Fannie Mae required quite a bit more a unit, but now you only need 5% down, up to a 4-unit property. Now, if we want to buy a second home or a vacation home, we can go conventional and, put as little as 10% down. Rates and terms aren't the prettiest right now because I think the big wave we've seen over the last couple of years of folks buying a second home or vacation home and then renting it out, right? Airbnb-ing it for, most of the year or part of the year. Fannie and Freddie don't love that. And so they've kind of put a tax the last 2 years on interest rates for second homes. They used to be rated the same as a primary residence rate. It's no longer the case. You're now going to be rated like an investment property. So your interest rate's going to be a little bit higher on a second home to kind of deter people from doing that, buying second homes or vacation homes. They felt like the portfolio, if you will, of loans out there for second homes and investment property was too high. And so they, to prevent what happened in 08, that's just kind of one of the stops they put in place is higher interest rates on vacation homes. Now, if we do want an investment property, which is typically the way to go, 20% down at a minimum. If you're going to buy a multi-unit property, it's going to be 25% down. Now, one of the best loan programs out there is here, the next one, VA loan options. These veterans have earned these, options. And so I love working with veterans. And the beautiful thing with the VA loan option is there's really not a loan limit. But the higher you go, like let's say you get up into that jumbo threshold above 766,000, depending on the amount of eligibility that the veteran has, they may need to put some money down. But as long as you're going to occupy a property, you can get in 0 down with a VA loan up to a 4-unit property. So a lot of flexibility there. We'll get into a couple other really cool caveats with VA loans here in just a bit when we start talking about credit. But USDA loan is another one that's available. It's going to be like Tooele County areas, Saratoga Springs, Eagle Mountain. You can use a USDA rural housing loan, and even further south than say like Utah County or even further north, right? Once you get up far north and out west, there's some areas that would be considered rural that you can utilize this. It's a 0 down loan, fantastic rates. It's a great program. Biggest challenge with getting folks approved for USDA right now is where interest rates are at, because they're very, very strict on debt to income ratios. Now, what I mean by that is that we take the gross monthly income and also take their monthly debts, and their total debt, meaning anything on credit plus the new mortgage, can only be 40% of what they bring in income-wise per month. So they do a hard cap. I think it's 42% is actually what it is. Hard cap on that. So with the higher interest rates and the average home price, that payment's pretty high. And there's also income restrictions with USDA as well. You can make too much money to qualify for USDA loans. So if you can fit into that little box, it's a fantastic loan option especially for a first-time home buyer. Do we want to pause after this slide, Phil, before I move on to the next and go over any questions?
I have a question.
Sure. Yeah, go ahead.
What's the refresher time for the first-time home buyer for primary residence? I know there's a refresher, like if you have.
I think it's 3 years.
Is
Is
it
it 3 years, Matt?
That's right, 3 years. So if you have not had any ownership in a home, meaning you've not been on title, doesn't have to be a mortgage, but if you've not been on title for a property in the last 3 years, you've hit reset on all the first-time home buyer benefits. So that would be, this 3% down option, conventional, could be, first-time home buyer grant programs that are out there. So we can get a lot more into the weeds with those other programs if we want, maybe on a later training. But yeah, you're going to hit reset after 3 years.
Sorry, I have one more question to follow up with that.
Sure.
Hopefully it's not too far into the weeds, but I know you can draw from 401k for first-time home buyers. Is that the same rule for a refresher too? Like if you've done it once, can you do it again after that 3 years?
You can utilize your 401k assets. They call it a hardship withdrawal, which is kind of an interesting way to term it for I'm buying a house, so I need to take a hardship withdrawal. But you can pull those funds out of a 401k account. If you don't have to be a first-time home buyer to do that. I believe you can do it multiple times, but it may come down to, you know, the exact type of retirement program that you're pulling from. But we're not going to have a restriction on our end.
Good enough. Thank you.
One thing, folks, when we're speaking of 401k funds, one thing folks have to keep in mind is that they do have to pay. Like for example, I had a client a couple of years ago that needed $60,000 from his 401k to help buy his home. I told him, I said, okay, now when you ask them for 60,000, that you need to pull out 60,000, you need to tell them you need to net like 60,000 in your account, not the total pull of 60,000. So what they'll do, depending on the scenario, and he was not a first-time home buyer, they're going to pull out a portion of that to be held for taxes, right? So he came home with like 40-something thousand instead of the full 60. Well, they pulled 60 out, but they held a portion for taxes. So he didn't have enough. So we had to go back in and get more. So I always tell clients that make sure when you're talking with your 401k provider, that if you need 60,000, you need to tell them I need a deposit in my bank account of 60,000. So pull out whatever you need above and beyond that to be held for taxes. So it's just something that, you know, we'll coach them through, but sometimes even when you feel like you coached them through it, they still don't, you know, it doesn't register, right? So it's just something I learned that, hey, I've got to really drive that point home, not only with the client multiple times, but also with the real estate agent. So, you know, you guys are aware as well. Because I know a lot of clients will divulge a lot of information to you. So if it's something you're aware of, it's something you can help remind them of that, hey, we got to make sure when we use the 401k funds that we actually get the amount we need.
Any other questions for him on this slide? All right, let's go to the next.
Cool. All right, guys. So there's three major things that come into a loan approval: credit, income, and asset. So I just wanted to touch base briefly on each of those three topics. So credit. So kind of minimum credit scores for somebody to get a mortgage is going to be 580. Well, obviously, the higher the credit score, the better the rates and terms are. So one of the first things I'll do if I pull somebody's credit report and they don't have, I would say at least a 720 credit score. That's kind of be like a quality credit score. If they're not at a 720, what I'll do is I'll see if we have any opportunity to do a rapid rescore. Now, what we can run is what's called credit analyzers. So they'll run a different algorithm for each of the three credit bureaus and generate a report with some feedback. It'll say if X, Y, and or Z were different on this person's profile, the score would improve by X amount of points. And it's very specific, like pay down your Bank of America credit card to $417 and you'll yield 12 points. It's a very, very detailed report for us. So I always like to see if there's an opportunity to do a rapid rescore to help boost their scores. Like let's say they're below a 580 or even just below a 720, because I really want to help these folks maximize their credit score and get into the best rates and terms available. So that's one of the levers that we'll pull if credit's not where we want it to be. Now, another thing that I always like to bring to people's attention is paying off of debt, right? So some folks may need to pay off debt in order to qualify for the home they really want, right? Free up some money in the monthly budget that we can use to qualify for a higher price point home. So there's a couple of different ways that you can go about paying off your debt. You can pay it off at closing as part of your cash to close. It'll be a line item on the closing disclosure that says, pay off, in this same example, Bank of America credit card. Here's the balance that, you know, they're going to come in with, you know, cash to close, just like as if it was part of their down payment. Then the title company will cut checks, disperse out to Bank of America, pay off that credit card. Well, if they pay it off prior to closing, the only time I would ever recommend that is if we need to do a rapid rescore. Because the amount of documentation we have to get if you pay something off prior to closing is about 4 times what it is if you pay it off at closing. So if we pay it off through closing, all we need is a payoff letter. That's it. To show the exact amount we have to have them come to closing with in order to pay off that account. If they pay it off prior to closing, we have to document with the creditor that it's been paid off. We also have to document with the credit bureau that they have paid that off. So give them the letter from the creditor. We have to do essentially a rapid rescore. Then we also have to document the source of the funds they use to pay off that account. So more bank statements, right? So it's just a lot less documentation if we pay off the debt at closing. So if you have a client that you know has to pay debt off in order to qualify, I strongly recommend to them to pay off at closing, right? As opposed to paying off prior. Because if they don't need to do a rapid rescore, let's say their score is 760, but they just need to pay off some debt to be able to qualify, I strongly encourage them to pay that off through closing as opposed to prior. Now, some loan programs will require it to be paid off prior to closing and document it. Those are typically jumbo loan options, but your traditional loan options, you're going to be able to pay off at closing. And here is where I mentioned VA. This is one of the other reasons I absolutely love the VA loan option, is that you can get a credit from the seller to help cover the closing costs and or pay off debt at closing to qualify. So if they've got, say a $5,000 loan, they've got to pay off a car loan or something in order to qualify for the home they're going to buy, the seller can actually pay off that car loan for them. That's a pretty cool feature with a VA loan, is that you can use seller concessions to not only cover closing costs, but also cover off, pay off debt. So that's a great option. Now, again, kind of back to debt to income ratio, DTI. So there's two different types of debt to income ratio. We've got the front end, which is for the housing expense, and we got the back end, which is for their total debt, meaning anything on credit plus the new mortgage, right? So there's two different numbers. And, I mentioned earlier that FHA was very, very flexible with that back end ratio, but they are a little bit conservative on the front end ratio, meaning that if the housing expense goes greater than 42 to 43% of their gross monthly income, it's kind of where you get into a gray area with FHA and their willingness to approve. But conventional is a little bit more friendlier on that front end. They've got a hard line in the sand on the back end, right? Like 49.9% is kind of the max debt to income ratio you can go on a conventional loan, but your front end ratio can be 49%, right? So conventional is a little friendlier on the housing expense. FHA is a little friendlier on the back end ratio. Any thoughts or questions on credit?
I think we're good.
Okay, cool. Moving right along. So income, right? Probably, I would say, most important, right? We got to make sure we can pay our bills, right? And cover the new housing expense. So there are some other unique programs that we can dive into, but the basics here, since we're talking Mortgage 101, the buyer has to have a 2-year employment history total. Does not have to be consecutive. So like, we're all in Utah, right? There's a lot of Mormon missionaries. So in that scenario, I've worked with a lot of them in the past where they worked like a year during high school at a W-2, just part-time job, went on their mission for 2 years, came back, they've been reestablished in the workforce for a year. Now they're eligible because we have 2 full years of employment history. It does not have to be consecutive, can be broken up. We have to explain the gap for the 2 years, or it could be, mom or dad, right? Well, have kids, right? And one spouse stays home and helps raise the kids, work for, a year before having kids, took 3 to 5 years off, come back after, kids are of age to where they felt like they could go back to work for a year, right? We bridge that gap that, we got a year before kids, a year after kids have kind of gotten old enough and got back to work. As long as we can document 2 full year history of employment, that's a minimum requirement on loans. Does not have to be consecutive. Now, kind of a caveat to that, like let's say you were going through like nursing school or something, did not have employment history at all, right? It went from high school, no job, right into nursing school for a couple of years, just finished my nursing school, just landed a new job, haven't even started it yet. So I have not collected a pay stub in my life. I can still qualify for a mortgage because we'll utilize nursing school or college in itself. We can utilize that as employment history. You were in training, you were paying for that training. You weren't getting paid during that training period, but you were in training to prepare yourself for your career. And we can actually close you up to 90 days before the start of that future job. As long as you've got guaranteed minimum hours or salary and a specific start date, we can close you 90 days before that new job starts. So if anybody knows any nursing students or college kids that are ready to graduate in the spring and you know, maybe have landed that first big job, get them into a home without even of collecting a pay stub or a W-2 ever. That, speaking of W-2s, just 2 years most recent. So again, with the gap in between, if they're a missionary or a mom or a dad at home raising kids, we're going to want to get last year's W-2 and then whatever their previous W-2 was, even if it was 3 or 4 years prior. So we want to just help document that 2-year history of employment. Most loans these days, unless you're self-employed, you do not need to provide tax returns. It's basically just 30 days pay stubs or a verification of employment from the employer and 2 years worth of W-2s is kind of the basics. Now, if you are self-employed, and there's some caveats here, but the basics, you got to have a 2-year consecutive history, right? So meaning the most recent 2 years on the calendar, you've had to have been self-employed and filed tax returns. Or if you're like you guys are 1099 independent contractors, same thing applies, right? You've got to qualify for a traditional mortgage. You're going to need a 2-year history, document 1099s, document tax returns. Now, one thing that underwriting will require is a current year profit and loss statement. Now, since we're in January, if you're closing in January, we're not going to need a year to date, right? It's kind of gets after the first quarter is where we're going to need a year to date profit and loss statement and balance sheet. But those two things, profit and loss and balance sheet, have to support the prior year's income, meaning that your income's got to at least be flat. Hopefully it's increasing, right? If it's declining, that can create challenges. You know, that we've got to answer for. If it's a significant decline, you may not qualify, right? If it's a smaller decline, like a 10 to 15% decline in income, sure, well, you know, you're probably still okay. It's again at underwriter discretion, probably still okay. We just have to answer for it. Why was there a dip in income in 2023, right? Well, mortgage rates are 8%. The market wasn't quite what it was in years prior, right? So you probably all go off of, if you had a banner year in 22, down year in 23, your income average is probably going to be based on 23 alone. You wouldn't be able to use the prior year to help bring up your income average. We would just go off of the most recent year's income average to be conservative for underwriting. So any thoughts on any of that, especially with y'all being 1099 independent contractors? Any questions?
I think we're good.
Okay, so a couple of caveats to this, right? So outside of the box, non-traditional mortgage options. You don't necessarily need 2 full years of being self-employed. We have a bank statement loan option that you need 1 year history. So 12 months is all I need, 12-month business bank statements. I show the deposits as income, and then we essentially add those up, divide by 12. There's your income average for, you know, for your business, right? For the 1 year. We'll go off of that. If you land and if one of your clients lands a new job, but it's 1099, as long as they have like you don't have to have a 2-year history, as long as they have like a minimum guaranteed income, we've got an option that we can close even before they start their job, right? So there's a lot of flexibility, I guess is what I'm saying. We're just speaking to kind of traditional guideline and requirements, but if you're self-employed, we have options if you're less than 2 years, whether you're self-employed or 1099, you kind of get lumped into the same category. Best thing to do is if you got a scenario, reach out. Would love to go over it with you. Now, last of the 3 is going to be assets, right? So kind of traditionally speaking, you got to have 2 months worth of bank statements, most recent 2 months worth of bank statements. And a few things that underwriters are going to look for on those bank statements is large or odd deposits. We've got to source those. So if they're payroll or say like an IRS tax return that we're all going to be getting here pretty soon, hopefully we're all going to be getting, those you don't have to answer for, right? They're going to be sourced because it's going to show direct deposit from your employer or from the IRS. But if like, let's say, you know, grandma gave you $5,000 for graduating college or something like that, right? So you're just depositing cash into your bank account and you're trying to use those funds to buy a home. There's a challenge there. We've got to call that $5,000 deposit a gift from grandma, have her fill out a gift letter, or we've got to let it, you know, season up for 60 days. And we'll kind of get into a little bit more of that. But there's kind of a general rule of thumb in our industry that if the cash deposit or odd deposit is less than 50% of our gross monthly income, so for easy numbers, if you make $10,000 in a month, and the deposit's less than 5,000, most often we don't have to source that. But that's not always the case. It's at underwriter discretion. And here's an example. Let's say, again, same example, you make 10,000 a month and you had a deposit last month of $4,000. The previous month you had a deposit of 3,000 and another 4,000, right? There's some big lump sum deposits in there that are all underneath that 50% threshold, but we need to use those funds to buy the new home. An underwriter may ask that question, like, hey, I'm seeing reoccurring deposits here in your account. What are those for, right? They're pretty large. They're not 50%, but they're pretty large. So that's something we got to keep in mind. Because, and then also reoccurring charges is something that underwriters will look for, because not every creditor reports to the credit bureaus. But if we've got 2 monthly bank statements and we show both bank statements on the 15th of the month, you got, say $450 being debited from your account for some service, the underwriter is probably going to ask, well, what is that service? Is it something we need to account for in the debt to income ratio? Is it just like a liability that's not debt you owed that's not being reported to the credit bureaus? So that's a couple of things we've got to look out for, is large or odd deposits, and then reoccurring charges. And kind of back to what I mentioned earlier, the odd deposits, right? Like let's say grandma gifted you $5,000 and she doesn't want to fill out a gift letter. Well, we got to let those funds season for a minimum of 60 days. By that is that we've got to provide underwriting 2 bank statements that don't show those funds deposited. So meaning that they got to be essentially from 60 to 90 days ago deposited. We've got to have 2 monthly bank statements showing they're not on there as a deposit. At that point, those funds are what's called sourced and seasoned. So you no longer need to worry about, documenting that. So some things that people got to keep in mind. Now, again, with assets here, one thing that I think a lot of folks don't quite think of, especially when they're first-time home buyers, is closing costs on top of their down payment. Now, right now in this day and age, we're still seeing a lot of seller credits, right? Being able to negotiate with the seller to kick in and help cover closing costs. But I think there's going to be a point this year where we're going to shift from an affordability challenge, meaning a buyer's market, back to a seller's market if rates drop like they're anticipated to, right? We're probably going to see the end of seller credits on 9 out of 10 transactions. It might be 1 out of 10 where we see seller credits. So closing costs, kind of in northern Utah area, you could expect anywhere from about 2.5% to 3% of the purchase price is what our clients need to plan for. If we can get seller credits, great. I think they're always better than a price reduction. A seller credit is going to help combat affordability 300 to 400% more than, say, a price reduction would. So if we got for example, like a 3% price reduction, might move the needle $100 on the payment. But if we got a 3% credit, we could save us $15,000 at closing. We could save, if we do a 2-1 buy down, $500 to $600 a month on the payment, as opposed to a price reduction that's going to just save us, $100 a month on the payment. Now, gift funds are great, right? We love gift funds. They've got to be from family. It can be distant family. It could be like an adopted, uncle or something like that, great uncle, right? Like it doesn't have to be mom or dad, grandma or grandpa, or a sibling. Right? It can be a distant relative or like a fiance or a significant other, right? Like we could get away with that as well. But they've got to be some sort of relation in order to use gift funds. And with gift funds, we can use those on any of the traditional loan options for all of your cash to close. So FHA, everything that's owed at closing can be covered with a gift. Same with conventional, right? VA is super friendly with gift funds, and so is USDA. We have to source them, right? So kind of back to the paying off debt at closing or before closing, kind of rules apply here as well with the gifting. If you have a client that's going to get gift funds from family, it's so much easier if they just have the funds wired to the title company as opposed to deposited in their bank account. And it just comes down to documentation and time, right? If they're wired to the title company, all I need is a gift letter, which is just a 1-page document, fill in the blank form, names, property address, relationship, and amount they're going to gift. Super easy. And then a receipt from the title company that they received the gifted the wired funds, right? The gifted funds. If, mom and dad or grandpa deposit money in your buyer's bank account, we have to get a bank statement showing that the funds were received. We have to get a bank statement from the donor that's showing the funds left their account, right? And most donors don't like to give up bank statements, right? Privacy, right? So I always tell clients, make it easier on your donor and have them just wire the funds to the title company. If they wire too much, because we don't know what the exact, cash to close figure is going to be until a couple of days before closing, but they want to get the wire out early, they can overwire. And then once the loan closes, the title company will just disperse the funds back to you for the overage, right? So they're going to get the money back. They're going to get their change back, right? Or you're going to get the change back as the buyer. So always have them just wire directly to title, don't deposit, right? It's just a lot less of a headache. Any thoughts or questions on asset? Anybody had a scenario or something they want to go over?
We'll see you. I think we're getting that.
Okay, all right. Well, that's kind of the big traditional, credit income asset, mortgage type, like any other thoughts or questions in general, guys? Like anything I can help with? Anybody have a case study they want to go over real quick?
I heard with FHA that if your credit score, you can actually go all the way down with a credit score of 500, but the down payment has to be 10%. Is that still accurate?
Yeah, so there's some, again, we were speaking traditional, there's some lower credit score options, but when you start getting outside of the box, right, of the traditional type loans, it kind of even comes in hand with like the self-employed 1099 stuff too, right? If we get outside of the box, we've got to expect outside of the box down payment requirements and also outside of the box interest rates. So obviously higher rates, more down, because everything in mortgage is broken down into layers of risk. Right. So the riskier the loan, and then from an investor side of the equation, in order for them to get comfortable with your case, right, they're going to want a little more down, or they're going to want to charge you a little higher interest rate, right, to get them feeling comfortable with taking on your loan. Because in most mortgage scenarios, the investor is holding more risk than the buyer, right? I mean, the investor's putting more than 50% in, I guess is what I'm trying to say.
Looks like Renee had a question for if you had any programs for people that don't have credit established yet.
Yeah, so there's, again, outside of the box type loan programs where we can use non-traditional credit. Now it's going to be what's called a manual underwrite. So you're going to be a little bit more restricted on debt to income ratio. But what we can do is pull in cell phone bills. Like, do you pay your cell phone on time? Do you pay your utilities on time? Right? Like we can string together non-traditional credit and get an investor, like FHA is kind of a common one, comfortable with the scenario, with the case, right, without having credit, and be able to, move forward and close that loan for the buyer. Now, here's one beautiful thing about a mortgage is that it is one of the best things to help boost your credit score, right? So you may get in with unfavorable terms on a non-traditional mortgage loan, but what's going to help you out is that by getting that mortgage and getting that payment history, reporting on credit, it's going to spike your credit score, right? It's going to create a really healthy credit profile to where, say, 6 months to a year from now, let's say rates drop, like we're looking to do a refinance. Well, now you got a credit score. We no longer have to stay on the non-traditional credit loan with the higher interest rates. We can enjoy lower market interest rates. So it's going to be a temporary loan because it's one of those where we're going to want to get them out of that loan sooner than later, just because of the unfavorable terms they got to come in with.
What are the kind of the standard front and back end ratios for FHA versus conventional? I know you kind of talked about it. I didn't make a note though.
Yeah, so front end, and again, there's not really a hard line in the sand with FHA, but you're kind of in that, I would say 43% on the front end, 50% on the back end. But again, there's flexibility there. It's not a hard line in the sand with either one of them. It's all kind of case by case.
Right.
But I see more often conventional automated underwriting approving a higher front end ratio than I do FHA. FHA can get a little bit strict on the front end ratio. Now the back end ratio they're going to be flexible on, and I mean.
So are you still seeing that 4350 with credit scores at 580, or does that change at that credit
I'm
score.
guessing that's gonna change. But again, like I just pre-approved a client today, a 630 credit score with a 53% back end, and the front end, I'll have to pull that up. I might be able to pull that up here real quick, just to give us an idea.
Is it the underwriter that decides on those ratios, or?
Automated underwriting, so it's a computer algorithm that's run. So it'll
Gotcha.
scrub through credit, income, and asset, right? They'll go through the credit report, go through the application, go through the income you've entered, and the amount of assets. Now, actually, I'm corrected. Their back end was 53, but their front end was only 39. So
Okay.
that's why I think FHA approved it at such a high back end ratio, is because the front end ratio was kind of below that 42, 43 threshold.
And then conventional is capped at 49.5 on the back end.
Like 49.9, right? Like as long as it's below 50 on the back end, the front end can be flexible. The one thing conventional likes is higher credit scores and some liquidity assets, right? Like if, for example, if you've got, if you're putting 10% down and you've got a bunch of money in the bank and your housing and debt to income ratio are both 49%, meaning you have no other debts, right? It's just going to be the mortgage. I've seen housing ratios get approved at 49%, right? Front end and back end ratios both 49% and get them approved. But again, that's with a good credit score and a little bit of money in the bank.
Okay.
But they're not flexible on the back end ratio, conventional's not.
Anybody else have any questions for Matt? No? We're good? Okay. All right, Matt, I appreciate your time.